Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly market update. Happy Veterans Day to all our veterans out there. Hope everybody's having a great day, and thank you for your service. So, guys, we've got some very exciting information to share with you today, and I'm going to jump right into it. I'm going to share my screen here with you and explain to you what's going on and what I am so excited about. All right, here we go. So, you know, the Fed just came out with some really amazing information yesterday, and that is that as we forecasted, and stolen from Barry Habib and MS Highways, we have some great news yesterday, and that is that we see that the Fed was looking for numbers in the sevens and maybe an increase of point 5 or 4. It came right in that range as far as inflation is concerned. And remember, inflation always drives mortgage rates. Inflation goes up, rates go up, inflation comes down, interest rates come down. So, without getting too far into the weeds of that and understanding that the Fed is using interest rates and the Fed's fund rate increases to combat inflation, do what's called demand destruction, we see that the numbers that came in yesterday, basically, that's starting to happen, just like we said with this announcement on November 10th, yesterday, that we would probably see the beginning of a slowdown. Now, the inflation is still going, it's still up, but it's a slowing going up. And that meant that yesterday, interest rates basically you went down 1% as far as mortgage rates are concerned and as far as the housing market's concerned. So that's great news. And, we can actually look at let's see here. If I can get into the chart, and there we go. So if we look at this chart, it's a lovely date. Thanks. The CPI, November 10th. We can see that this October compared to last October, all right, looking at the CPI and the inflation and how it's all calculated with compounding and rounding, and to get these numbers, right? And I kind of went into this a little bit more detail in another video I done recently on the forecast for 2023. This falls right in line with it, and we're seeing that the numbers, the way they kind of look at it is the numbers for this October, okay, because everything lags a month, so the announcement came out in November for October. We're 0.3, and now with an increase of 0.3. And last October, it was 0.6. So inflation was going up at a higher rate last year and the month prior also. So we're seeing that, as these year over year numbers replace each other, that's a good thing. We saw this back a few months ago when you see in July there with the other dip. And what happened back then? Rates went down to almost 5% or right around 5%, depending on the day and everything. Again, everything fluctuates by the day and all that. But so, in other words, this is really good news right now with what we're looking at. And of course, we're seeing other stuff happening, which is normal when it comes to this sort of activity of high inflation, high rates, and all that, which brings about some unemployment. So we went from like 3.5 to 3.7 in unemployment, and we saw some unemployment filings, some hits to the tech sector, like Facebook just had huge layoffs, Redfin, stuff like that. Actually, in Arizona here, we're seeing still our tech industry as a whole is still growing and thriving. I know there are some layoffs, here and there with different industries and stuff, but Facebook just laid off like 11,000 people. Redfin had a layoff of like 13% I think it was, of their workforce. So, but these numbers that we're looking at in this chart, this is what really drives the interest rate. So we see that one of the other big drivers for the market and the way we're looking at the inflation and CPI numbers and everything is the drop we told you was coming is happening. um, you know we see that they're doing their demand destruction thing with the higher rates and all that, like we've talked about before. But rents, basically make up about, it's a big driver of the market. Rents, take up, or shelter costs take up about 39% of the core inflation cost. Okay. So there's overall inflation, which includes everything, and then there's the core inflation, which strips out food and gas, because the Fed can't control those things. They don't control the weather for the crops and how they come out, and they don't control food prices from that standpoint. And they also look at, when they strip those things out, they don't even look at energy, because if there's an oil embargo, pipeline bursts, or something to that effect that they have no control over, so they're not looking at those numbers. So, but they do look at these shelter costs, and this chart basically shows us that we had, as far as overall shelter, month over month, an increase of 0.8%, increase a year over year. Rents up 0.7%. Okay. And then there's this other indicator, which is interesting too to look at. It's the OER. Okay. So the OER is the shelter away, which is like, you're going on vacation, and during the holidays, that's usually a really big thing, right? So, they look at the hotel prices are factored in, obviously, into this, and the cost of shelter for going on vacation. And people are saving more money, spending more money, just like we always see in these inflationary and high rate situations. Going into people bookings for September, October, November, and those in December for the holidays. So there's a big lagging effect here, that's factored in. We'll start to make the turn coming down. If you also look at those rents year over year, you got to keep in mind that those are year-long agreements, right? So there's a little bit of a lagging effect there. Some of those rent numbers stay higher, so there's a lot of these long-term leases for maybe a year or two. That last year, when inflation was really on the run, those peak leases and numbers and rates and stuff like that were a little different. So we're going to start to see all these lease rates and these leases, start turning over and start lowering of these numbers a little bit on their increases and their fast increases and things like that. And that's going to make a big difference, and you're going to see a difference in the slowing of inflation there also. So, this is not to say, on Monday or next month or whatever, something comes out of left field, like we talk about some catastrophe or some big thing happens, and markets go haywire and all that. But for last week, we know we're saying rates. So I'm not saying rates couldn't fluctuate or whatever, or rates are going to drop to 4% right away or whatever. But last week, most lenders were talking, somewhere in, when they were quoting a loan and stuff, they were probably around at least 6.5 to 7.25, depending on the day, over the last week or two. A lot of them were quoting over 7. So, today, if you're quoting, like, hey, we're at like 6% or just above 6%, that's a huge difference, right? So, we are going to continue to see layoffs as the Fed continues to tighten monetary policy. That's just kind of part of the game here. But it's not it's not something that we can't overcome. I think I may have actually lost one of my slides here. Let me just double check. Okay. let's see. Nope, I got it. Okay, great. Okay, sorry about that, guys. So yeah, so what I wanted to kind of explain to you is that there will be a kind of a lagging effect on some of these numbers. The Fed usually, whenever they take action, which again they took action way too late and everything, we already talked about that before many times, but usually it's about a 2 month, 4 month, maybe even a 5 month before you start really seeing some of this stuff really taking hold, and we're starting to see that now. And it's definitely happening. So again, there may be a little bit of fluctuation here and there. We're expecting them to raise the Fed funds rate again in December, probably in January by about 50 basis points and all that. But that's why with looking at this and looking at where, even with knowing that, pretty much these numbers is what we're seeing on interest rates for mortgages. They're already baking all this in. It's already kind of included into the equation. So we're really, and like, again, unless something weird happens, we're really not going to see rates. At least we're not going to probably see rates jump back up or anything like that crazy. Okay, so this is good news. This is great stuff. And we're going to probably, and that's also why some of the economists are even talking about maybe by the end of the year, we won't see them go up, but we might actually see, again, if we've got some more good information coming up over the next few weeks, and the Fed again is going to be meeting again in about another month, December 14th. We may see, hey, numbers are still going well. We could see another drop in there leading up to that. So we'll keep an eye out for that. We could see rates around 5, just like some people have been forecasting, and we had mentioned before. Okay, by the end of the year, we're not even getting into next year. So fingers crossed, right? So as I think once we saw this around July, once we get around that 5 mark, 5.5, 5.25, 5, maybe even going under a little bit of 5, by the first quarter, we're going to see a big difference in the market shift like we saw back in July. We saw, stuff going under contract a lot faster around then. And then, of course, once we go into the new year, we go into tax season, we go into school letting out and those sorts of things. And then people are really thinking about moving on and doing whatever they're going to do, especially with the lower interest rates. So right now is the time to get a great deal on a new or resale home. And then you're getting better rates than you were just a couple of days ago. And you can always refinance, in a few months down the road, right? So that's something to just keep in mind, guys. Get the good deal now while you can, and then move on with a lower interest rate later, and take advantage of that one drop. So one interest rate drop. Let's just take a $300,000 home as a real practical, real life example. $300,000. 1% difference in that, you times that by that 1%, and that 300,000, that gives you that gives you $3,000. Okay, you divide that by 12, and that's a $250 a month savings on a $300,000 house, just to use round numbers and a basic example. Okay, in general numbers. So, guys, just a 1% difference. $250 a month in a payment is a boatload of money for, I think, most people. Who wouldn't want an extra $250 a month? I'll take it. You're going to give me $250 extra a month, I'm going to take it. All right. So, guys, just a real life example there of how much more buying power somebody might have, or how much they can save in their current payment by refinancing with no out-of-pocket cost. So let us know if you have any questions on that. And yes, again, we're still a little ways from the super low interest rates, but we're going to get there. We're going to get there. Trust me, we're going to get there. All right. So going back to the original chart here real quick that we started with, we just saw this huge growth in the bond market, and it wouldn't take much. I mean, look at over here and how fast that went up in one day. So it wouldn't take much, right, in the way of good news on the inflation front to get everybody excited again in a day. And take it to even a higher level and maybe see rates drop another 1%. We'll see. All right. Let's give it about a month or two and see where things shake out, right? Maybe something will come out of left field and it'd be completely wrong. But so far, we've been right. We've been moving right along. Everything makes sense. Everything, we know historically and the way the market works with inflation and rates has been right on. So, all right. So, guys, I think we're this is fantastic news. Nobody wants to go through a recession, but a recession also means things go on sale. Things need to be unloaded. You can get some good deals, and that includes on homes. That also means when we go into a recession, which we usually find out we were in a recession back a few months earlier, like I mentioned in a couple other videos. Usually the Fed to get the lead out, right? But the Fed has about a 2-month on average lag time of letting us know when we've been in a recession already. So keep that in mind. But when we go into a bad economy, you're going into a recession, it always means lower rates. Okay, it's just how it works. I think bad economy means lower rates. Eventually, we get to lower rates. Okay, and that's how inflation and rates work together that way. So, getting into the market here in local Phoenix a little bit more. We're 57 days closed on market. We have right now, and again, remember, we're very seasonal, like a lot of places. Real estate is very local. Our market's totally different than Miami or New York, but in Phoenix metropolitan area, we are at a 5.13 month supply. Our sweet spot, like things moving along pretty brisk, is going to be about 2.5 to 3 month supply. Between 4 and 6 month supply is a lot slower market for us. And that has to do with the time of year plus the rates, and you throw inflation on there that people have been getting hit with. And it's just a lot all at once. And it's just kind of a mind shift and an adjustment. But we have 5 month supply. Absorption rate is 19.5%, not as moving as fast as we'd like to see. The average list price is $688,000. The average sales price is $543,000, and we have 97.09% list to sales price ratio. We like to see that just over 98. So that's a little on the lower end. Again, kind of going with the market, time of year. And the actives are down just a hair, almost down 1%. Our distressed properties are almost nothing. Actual short sales are down 3.8% in volume. And we had 25 total short sales over the last week. I mean, that's kind of nothing in a big market like ours. Lender-owned REOs, 27 of those. HUD, we had 6. So it's not much, guys. So the distressed market just is there. As a matter of fact, closed month to date, not for short sales, is down 25%. Lender owned is down 66% on that mark. New listings taken, we dropped 1.3% from last week. We're at new listings, we're at 1572. We usually like to be, you want to be at least over 2,000. We usually like to see about 2,400 on that number. And we're nowhere near that. Again, everything going on. There you go. Under $500,000, we are right now. Let me stop this share. Get out of this. Okay. For under 500,000 right now, we're sitting at 56.8% of the entire inventory in the market. There is just 21,000 homes on the market, just over 21,000. And that number, again, during the peak of the crash, I just have to keep bringing this up. Some people want to keep talking about the crash. That number for us was 56,000 back during the crash. So we're nowhere near there, guys. We're nowhere near there. Okay, just to put that at ease as far as the supply is concerned. That number under 500,000 is has been rising. We've been seeing more people putting those lower priced homes on the market. A little bit of pressure now with some of these numbers that we're mentioning as far as prices. Keep in mind appraisal prices, your neighborhood, all that may be different. When we say averages, it also means that there may be some more lower price homes coming on the market, so that can change the whole averages. It doesn't mean when we get into this in a minute, it doesn't mean that your home has come down that much. Okay, when we're talking about an appraisal, so let's keep that in mind too. All right, big difference. So we'd like to see that number, around 60%. And the historic average is usually around 70% for that number under 500,000, but prices have definitely changed. I mean, $500,000 used to be our luxury market, 500,000 and above. So again, the big thing here is, last week numbers for what's been under contract was 2861. This week we're at 2755. Again, way lower than we need to see. I mean, those numbers need to be up around 5,000 to really keep things going under contract, keep things moving. But again, we have the factors we have in the market that we keep stressing and talking about. The Crawford Market Index is something I always like to get in here. That Crawford Market Index. And again, just keep in mind when we're talking about all this, guys, once those rates come down and we get out of the holiday season's always slow. It just period, end of story. It's always slow. Every year you'll see the same curve measure. A lot of the fear mongers will show you 1 year, like, 1 year, like a regular year, not the anomaly Super Bowl year, but they'll show you 1 year where, inventory is dropping. Okay, inventory is super high right now. It's higher than things are moving super slow. But they'll show you that, during the holiday months. And it's like, guys, really, come on. It's kind of like, Market Watch, 150% increase in foreclosures this year. Yeah, but last year we didn't have any foreclosures because there was a moratorium on them because of the pandemic and blah, blah. So anyway, it's got to be within perspective. So keep in mind with all this, guys, once rates drop around 5-ish, which could be very soon, but let's just conservatively say by somewhere in the first quarter at this point, the way things are going, could be sooner. That is really, really going to light things on fire like we saw back in July. Okay, then also going into the busy season. But let's take a look at this Crawford Market Index. Basically from 90 to 110 is a balanced market, 100 being the balance mark. Under 90 is a buyer's market, and on the index over 110 is a seller's market. Right now we're coming in hot at 92.2 on the Crawford Market Index. That means we are technically in a balanced market, right? But we're heading towards a buyer's market. You go under 90, that's buyer. We're at 92.2 on the overall index. If the supply number and the demand number that I'm about to give you are the same, then we are in a balanced market. Right now, our demand on the index is at 78.2. Demand, of course, being buyers, right? And the buyers' demand is low for obvious reasons, time of year, rates, blah, blah, right? The things we keep talking about. So again, we'll see an easing on that once rates drop and get out of the holiday season. Demand, though, is if we're looking at 100 as the benchmark of a balanced market, we are down 24 points. Okay, from that, and supply right now is at 82.6. So demand is 76.2, supply is at 82.6. That means our supply is about 18 points or 17.5 or 4 points below that 100 mark. All right, so our supply is definitely at a lower mark. Also, all this means right now we're balanced to buyer depending on your area. And let's look at that. So if we look at the cities individually, we can see that Fountain Hills and Scottsdale, and technically Paradise Valley at 116, Fountain Hills being at 147, Scottsdale at 124. Those are going to be more seller's market, a little bit less getting money for concessions, talking people down on their price, negotiations, incentives, all that. Then Cave Creek and Phoenix are still within balance. Those are barely, but they're there. Cave Creek's actually 101, but Phoenix proper is at 90.4. Okay, 90.4. So they're technically in balance, but Phoenix is obviously sliding into buyer. Everything else, Glendale, Chandler, Tempe, Mesa, Goodyear, Peoria, Gilbert, Avondale, Surprise, Maricopa City, and Queen Creek, that is all in a buyer's market. And Buckeye is number one in a buyer's market. They're number one buyer's market. Now, last month, we were down 10.5%. In other words, our CMI came down overall 10.5% versus the month before at coming down at 8.8%. So we saw a little bit more of an acceleration there, but again, keep in mind, rates just dropped a day ago, and we'll see what that brings about with the next set of numbers. And also, we're looking at the time of year, right? So some numbers just to rattle through this and get through this for you quickly. We had 6,019 closed transactions down. That's down 42% from October of 2021 in the anomaly year. Keep that in mind. Always keep that in mind. It was an anomaly year. Okay. So that's down 42% from October of closed transactions. All right. Resale closings lowest since January of 2009. Okay. Resale closings lowest since January of 2009. All right. Got too used to those 3% rates, guys. All right. And inflation is killing everybody. That's for sure. New home closings totaled 1,410, up 4% from October of 2021. Okay. New home closings totaled 14,110. Now, keep in mind, with new homes, always think it's kind of like the same thing with rents. Always keep in mind, there's always a lag effect, right? With new homes, they could be, some of them could be spec homes where it's quick move in. But a lot of times when they say new homes in this, it means they started with dirt. So they started maybe several months ago, could be 6, 8, 12 months ago, 14 months possibly by the time these numbers come in. So there is a lag effect there. So new home closings totaled 1,410, up 4% from October of 2021. So keep that in mind when you think, that sounds weird. Yeah. Resale closings numbers, 4,609. That's down 49% from October of 2021. Okay. In the anomaly year. And we have median sales price was 470. That was the median sales price, 470, up 11.2% from October of 2021. So overall, the median is up, even though we know on average, and remember, lower price homes coming on the market also means, and a lot of those were probably investment properties too, guys. Just keep this in mind. I'm not trying to sugarcoat anything. I'm just saying a lot of homes have been on the market the last several months since April, May-ish, when rates were starting to go crazy and supply went up a little bit. Okay, just keep that in mind. Okay, that has an effect too, along with a lot of those iBuyers trying to unload their stuff for super cheap, and they're doing their price increase because they way overpaid by $50,000 to $100,000 more. Okay, just keep that in mind. All right. So up 11.2% at 470 median sales price. Resale prices, okay, resale sales price is down 8.1%. Okay, that's kind of been holding steady for about 2, 3, 4 weeks, I guess. But it's down overall, resales price down overall 8.1% since May. Okay. May is kind of when things went really crazy. Median new home sales price was 529,000. Okay. So remember, again, from those last two stats, we're still up overall, right? If your house went up to 500,000, but now it's worth 475, okay, just using round numbers, you're still up if the year before the house was worth 400 or 350, right? So median new sales price was $529,148, up 18.3% from October of 2021. Let me read that again. Median new home sales price was $529,148, up 18.3% from October of 2021. And remember, new homes counts as really new inventory. For, when they say new inventory, in reality, the new inventory is new homes, because resale homes many times means that somebody's selling a property and then buying another property. So it kind of cancels that out. So as far as new homes and family formations and all that, just to kind of keep that in mind, up 18.3%, right, guys? Huge number. So even though they've been lowering their prices, a lot of them been lowering right around 40 grand recently, give or take a little bit, depending on, and they're offering all kinds of closing costs. They're fixing the rates for lower interest rates. Guys, we can get you a great deal on a new home right now, even with a lower fixed interest rate than you might have to pay before. And trust me, in a few months you refinance, you're going to be like, wow, we really got ahead of the curve on this. Okay, so I'm working with a lot of buyers right now with that sort of scenario. I mean, we've got some new home builders with paying for all your closing costs, homes price reduced, they're fixing the rates at like 4.9%. They're buying down your rate like 4.9%. I mean, just some crazy stuff happening. And we're talking homes under 450, several under 400, or even under 350, guys. They're gone now, but there were a couple that were like in under 300 for 3-bedroom houses. Yeah. Anyway, median resale home price was 447,500, up 6.5%. Okay, up 6.5%. Median resale home price was 447,500, up 6.5%. Okay, overall. Remember, these numbers are going to start shooting up. Demand's going to start shooting up, right, guys, when rates drop even more, right? You mark my words. This is going to be a big one already with this 1-point drop. When we get to 5, or around 5, and we drop even lower than that, those two benchmarks, woo, median resale home price. Okay, so that I think wraps it up. Median homes, yeah, was 447. We went up 6.5%. So guys, I think the overall takeaway from all this is, we're basically right now kind of in a holding pattern with the holidays for a lot of people, right? But you can get amazing deals right now if you have a listing out there. Rates just dropped 1%. We've still got the 2-1 buy downs, the arms, and all that. We can get people into some great situations for purchasing your properties. People that are looking this time of year during holidays, they are serious buyers. So don't discount the fact that if you do get any show requests or whatever, if you're not getting any show requests at all, you're not the only one that's not seeing a ton of traffic right now. Let's see what happens with these with this 1% drop, and where that leads to as far as demand over the next week or two. But keep in mind, we are in the slow season, so things are not really going to ramp up until we get through the holidays. not giant gains anyway, but we may see a little race to the end of the year now with these lower interest rates. And if rates drop even more, and we see more easing in inflation, we could see a big runoff by the end of the year on these. And some people might even start refinancing again. Cash out refis right now, a lot of people are even doing those. That people are like, well, yeah, rates are not as low as I like them, but if somebody has some high interest rate debt that they need to pay off on, other kind of loans or credit cards or whatever, might be something to think about. So, guys, if you have any questions at all, give us a call, shoot us a text. Make sure that you're reaching out to us. You can always call or text us. And it's 480-788-8569. You can always email us at home@mincolagroup.com. And you can check us out online on social media. Make sure you subscribe, follow us, like us, share our program, and be sure you let your friends know about us. Check us out at mincolahomes.com, mincolagroup.com. Get search for the best homes, get you some information about pricing and whatnot. Guys, we'll see you next time. Again, have a great holiday weekend. And thank you to all the veterans out there. Guys, have a great time. Bye-bye.